Been better. My yen trade was a bust, but that's what you do. You try and then you go and. I mean, I still made money on the trade overall, but I'm very shocked. What some people are saying, some places I go to read say that because Abe has scheduled a press conference for Friday, they think that he might be stepping down. So I don't know. I don't know. I'll be very patient. I still have to get through the Fed meeting. I'm sure. Well, not the Fed meeting with Jackson Hole.
Jackson Hole. Did you consult the resident Japanese expert?
It's funny that you said that because I sent him a text. I haven't heard back from him. I said, "Oh, it's a press conference about the new biography."
I wasn't expecting that. That was funny.
I guess he thought his father was too big a wise guy. How unusual.
I ordered it.
It's be highly unusual. He's much more his mother's disposition than his father's sense of the street and being a wise ass his whole life. So,
well, that could probably serve him pretty well.
Yeah, it's absolutely. He's always been much more measured than his father. So I guess we want to. What's the primary interest? I'm sure it's the Jackson Hole.
Yes, Jack. Okay. Absolutely.
Are there any direct questions as to that?
Yeah, Robert had one just a second ago. Let me see if I can pull
always
it up.
Good. Robert is always.
Robert, can you? Robert, are you here?
Yes.
Yeah. Why don't you just ask? Ira?
Let it loose, Robert. Don't hold back. I know.
Yeah.
Okay, well, this one is not so sophisticated. I was curious, what would be the elements, surprise elements, that if you would take a clean sheet and say, you know what, knowing Powell, knowing the current situation, the most outrageous thing we can expect out of Jackson Hole is, what would it be? Because at the moment, I just see a status quo.
Yeah, it's a very good question. So let's see, I'll answer you in a Kantian fashion, a priori.
Very good.
Let's think about this. So now let me just step back for a minute because CNBC put out a piece. It was, that a lot of people picked up on. What was the actual headline of it? I don't want to. I thought it was kind of, let's see, CNBC. They put it out in such a fashion as to, come on, where's that piece? All right, I'll go to my other place where I park stuff. Come on. The title of it was, not there. I'm sorry for being a little bit slow here. No, I don't have it there either. What the hell did I do with it? Let's see. I know it was out all over the place. Oh, here it is. Powell said to deliver profoundly consequential speech, changing how the Fed views inflation. Now, I read this piece, and the headline again, of course, is crafted to draw eyeballs and maybe get a little volatility in the markets. And I mean that when I say that. It's unbelievable. because when you get to the content, I mean, the article really isn't that all that. But I would offer this up. After the way the FOMC minutes were crafted to walk back yield curve.
Oh, am I the only one that lost them?
Control,
No,
which I believe that they were. And can you hear me now?
No,
No.
yeah, now we can. Yeah, we lost you at
Okay.
the minutes walking
Okay.
back yield curve control.
Yeah. So when you see the minutes get rewritten many times if the chair wants to, and the chair does it only with the secretary, not with the whole Fed board. So so if things change in the interim and the chair wants to put out a different tone all the way to the release of the minutes, they're going through them and changing them. They're all done. The minutes are written at the pleasure of the chair. It's one of his great powers. So when I heard those minutes last Wednesday, I thought that Powell, my first response was that Powell had changed it to soften, to harden him, because his press conference was very, very dovish. But the minutes with the statements about the yield curve control seemed to walk back the dovishness, which is why we got, to me, the reaction. The gold dropped dramatically, the dollar rallied, interest rates certainly on the long end rallied. It didn't sustain itself for long, but that was the sense of it. And my personal sense was that Powell had gotten a little bit concerned about not that the dollar is really, forget about the headlines. The dollar has not been in this phenomenal, downward spin. It just hasn't been. It's nothing. If you look at it on a year to year, from where we were on December 31st, the movement has been nothing. You can put up right now and look at it. So on December 31st, the dollar closed at 96.50. Right now we're at 93.10. So what? That's about a 2.6% year-to-date decline. Well, that doesn't even garner a discussion as far as I'm concerned. Now, if you take it from the high made in March, okay, now the move is almost 10%. But that was a very, in March itself, okay, for the month of March, we had a 9 handle, an 8.5 handle range on the dollar index. So almost a whole year took place in March, except that when we came out of this in July, when we made new lows for the year, but for the dollar. So it's been really inconsequential unless you take the peak. Well, that's a silly analysis in my estimation, because that was at the height of the crisis. That's like measuring everything from the day of Lehman or the week of Lehman. Well, you know what? That's the exogenous period. Then the market has to smooth itself and find time to figure out what it's doing. So I don't make the dollar move all that much, but I think that Powell was reacting to some of the headlines, because the headlines every day over the weekend, I read one after another. Barron's had a piece to me that was so weak that I think an eighth grader wrote it, really, in analyzing the way the dollar. It was terrible. They're all looking for this great story that the dollar is going to be replaced. I didn't see these stories when the euro was at 160, let alone at 118. So I just, it's beyond me now. And everybody who's been following me or discussing with me knows that in late May, I turned bearish the dollar. So, but the move has been inconsequential. It really is nothing, only from the peak. Well, okay, well, I don't measure things from the peak. They're interesting to see where they stop, but I certainly don't measure it as taking, whoa, look at this massive move. It's nothing. But I think Powell did react to headlines again, a little bit nervous. So he walked back the yield curve. Now with the yield curve walking back, as the CNBC article, sets out, what is he going to lay out about inflation? And I keep going back to asking my question as which I'll ask in December but I'm asking now, is if unemployment is 9% and inflation is 6% on an annualized basis, does the Fed raise rates? And I would say that it's a 99% answer that I get when I ask that is no, because we know from everything that the Fed has laid out, the most critical element for the Fed is unemployment, because as Powell has continually reiterated, these people lost jobs through no fault of their own. That's a very big statement, no fault of their own. And as I like to point out, that makes the Fed a social justice agency. That's the path that they've chosen to go down. So tell me why inflation matters. So the most dovish aspect of this will be if they go to a smoothing inflation. So for 6, 7, 8 years, the inflation rate has been well short of its target, 1.5%, 1.4%, 1.6%, that they're willing to let it run hot for a while so that it basically smooths itself out over time. That's what I believe the market thinks it's going to hear. That the Fed is going to look at that, and they'll let inflation run a little bit hotter. Now, is that all they're going to say? I don't know. But I think that's what they're preeminently going to speak to. I think he'll stay away from the yield curve from the way the minutes read, because they view that as, I think right now, the most dovish statement that they can make. Because if they seek to do that, I think then the dollar will get hit harder and quicker. The gold will rally. The equity markets will probably perform well. But I'm if I'm sitting at the Fed, I go, you know what? This equity market is telling me maybe we've done enough already. That doesn't mean we're going to roll it back, by the way. It's just that maybe we don't have to do more. So if he gives forward guidance on that inflation and say, well, we're going to sit here, that's really like the same type of thing. And then the market could stop focusing on inflation, because the Fed's not focusing on inflation except to get it higher. The Fed is focusing on unemployment. Listen to them when they say that. They're serious. Because that statement about no fault of their own, that all these people have lost jobs, that they've been out of the workforce through no fault of their own, that is a very, very important statement. And you can see how many other people are now running with that, by the way, once really Powell put it out there and kept hammering on it. So the Fed is caught in this situation. They're not going to move because they're geared to unemployment. So, that's the way that I'm reading this. And the market now is setting up to, that there's not going to be yield curve control. That's what, we've seen a pretty sizable move in interest rates over,
Yep.
right? Not necessarily the U.S. Let's see. Yeah,
Sure, look at the 30-year.
10-year, the 30-year is down pretty good. But it was the European rates that really set the ball in motion. I mean, the Bunds dropped.
I didn't look at that.
Talking about. So there's and you've seen, so what happened? Gold's, dropped. At one time it was down almost $20. The dollar is weaker though. Now, it's not weaker. The yen is weak. and that may be because of Abe, because it was the yen was actually higher last night, and then when this started running around about Abe press conference, and I'm waiting for more clarification. Hold on. Hold on one second. Let me see if I can get them. Let me see if I can get a quick answer to this.
That brings up a bunch of questions in my mind, or just follow-ups too. The Fed focusing on unemployment with the infrastructure conversation that you, Rosenberg, and Rithold had the other day.
All right,
Hugely great podcast, by the way.
Oh, thank you. So what, I'm sorry. So let's go there because I can't get an answer. But, so now the dollar is, from a trade standpoint, and I'm letting this market breathe right now. I'm really not doing anything. I've got some wish orders in the gold, quite a bit below here in case because when these sell-offs begin, especially in anticipation, well, maybe the Fed's not going to be as aggressive as initially thought. And we know they're going to let, it's not news about the inflation front. A lot of people suggested that's what they ought to be doing anyway. So there's not a whole lot of new news out there in regard to that. So you may get some unwinding of these positions ahead of it. And again, it's still not a love affair with the dollar, because the Canadian dollar is higher, the British pound is nicely higher, Aussie's higher, Kiwi's higher, peso's higher. I'm just giving you the obvious, and the euro and Swiss are higher. The only thing lower is the yen. So where it's affecting the metals, but the metals have run so much further, even ahead as all the currencies. So there's some unwinding going on because, again, any sense that, well, we're not going to get yield curve control, which was the absolute, I think, at this juncture, the most aggressive monetary tool that the Fed could embark upon. And I think they're pulling back from that for the moment. They're going to hold that in abeyance, of course, depending upon how much treasury debt there is and how much need there is for the Fed to keep buying or so much of the paper that the Treasury is bringing to market. Okay, so let me stop there. Okay, so now where are we going with the Rosenberg and?
Real quick, where are you looking? Where are your wish orders in gold? I've got some orders down in 1870 to 1865 with a stop under 1855.
Same areas.
All right, that's what I thought too.
Same area. I have a small order at 1906.80, I think. Let's see right now. Yep, small order just because I have a support area there, just in case it runs that first level. Although I'm pretty sure if we get down that low, they'll try to take out the 1900 price on the. I'm talking about the D's contract.
Yeah, me too.
So we'll see. And metals, I'm saying, we've seen some. Look at the platinum's found a bid. So we got, and the copper's actually turned up now for the day. So the industrial base, those with a bigger industrial footprint, I should say, seem to be more involved with the robustness of the equity markets going, oh, okay, things may turn harder and faster economically. So we want to be ready for that. But I think that bleeds into the question that you wanted to ask from.
Yeah. So that whole conversation was great, and there was I hope you guys all had a chance to listen to it. I posted it as soon as I heard it, and I've got to listen to it again and again.
I just listened to it again myself this morning. So
and that's when to take notes. I mean, between you, Ritholtz was, I never heard him before, and
yeah.
So okay. Maybe it's going to take me a while to get used to his
style.
No,
I got a lot of feedback about, he seems to be pretty, what's the word I want?
Arrogant, cocky.
Yeah. But I know, I've read him, and I don't think I've talked to him in years. but I've read his stuff and I have respect for him. He writes for it and he's a good thinker, but
Yes.
you know, it ain't your way or the highway. There's a lot of other views, and which is why I wanted to press upon him that all depends what, you know, if you've got an investor's, you know, 5-year horizon, your view is going to be far different than what I'm looking at. So FOMC, it's do matter. And I would, there's many places I could have argued with him. You know, again, I'm always respectful. It's not my show. So just like I come here, I'm respectful. If I go to judge, I'm respectful because you guys are doing the work, putting it together, and you deserve that respect. So I'm not there to just, you know, shovel shit and throw stuff, you know, and see what sticks to make us sensational. I don't like sensationalism. I shy away from it, which is why I don't really, you won't hear me make price forecasts because I think it's a fool's game. I don't like it. So I like to engage and indulge in real discourse to try to ferret out, again, the best profit opportunities. But I'm never so sure of myself ever. As a very good friend of mine and I, we always laugh, and he's a great trader. When I put on a trade, I immediately assume, well, I must be wrong because why I'm the only one. Why am I seeing this?
I
Well,
was just talking about that.
yeah, I go through this all the time. So when it is, you know, this is the way it is, and I push back, you know, but I very politely. And then you know, Dave Rosenberg, he took a little shot at me, although he probably didn't realize that I was one of those who was very in opposition to his view on the bond market. And the way we started out in January is that was right, because the dollar, if you look at the charts in January, the Bloomberg Commodity Index was up at 81. We dropped all the way to, I believe, 59 during the height of the, hold on, during the height of the, I don't want to give out false information. So, okay. So on December 31st, the Bloomberg Commodity Index was at 80.88. We never have gotten, let's see, did we? Yeah, in January, we actually got a little higher. And then once the effects of COVID really set in, we broke all the way down to like 59.
Yeah.
That's and we talked about that in real time. I know that.
Yes,
so,
we did.
Substantial break. The dollar, of course, rallied. Even gold in March in that period sold off hard. Oil, we know what happened. So there was, you know, some phenomenal movements. So when the bonds started out the year, I'm looking at futures, which are making lows, by the way. Let's see. So again, come to January, and I'm on a continuation chart. The 30-year, which closed on December 31st at 155.17.
Oh, that was a great low.
And all January was hanging around there until the last week of January when the effects of COVID started to set in. So when he talks about, you know, the great return, the 25% return for those who were smart enough to buy bonds, you know, I push back somewhat because it was COVID that made it possible. But I didn't think that, I thought the bonds were going to actually break this year from based on what I saw the dollar doing and what the Bloomberg Commodity Index, but COVID turned everything. So if you've gotten those tremendous gains by being along the long end of the market and you've gotten a capital appreciation in your bond portfolio, I'd be taking it off. I would have taken it off a while ago, but I'd be with both hands flying because to me, this has made that view, COVID made that view right. Now, we can say too that COVID also made the gold, but it was not COVID. It was, of course, the Fed's response to COVID, where it was COVID that made the bonds do what they do because with the shutdown, we truly thought that they were going into a deflationary spiral. So that made sense. I'm, you know me, I'm not, and he says that people said, oh, anybody who buys the long end of the curve is a fool. I still believe that. And I believed it in December. And I'm not shying away from that because to me, it's why would I buy something that's a negative real yield?
Yeah, I thought that was interesting too. He's talking about it from he seemed to me to be talking about it from a trade standpoint, and I can see that. But
Yeah.
who's gonna buying him down there? I remember we had a low of 155.05, and I can't remember exactly when that was, but I believe that was the low. That was the low before we turned up in 19. I'm oh, there it is. It was December 30th. 155. God bless you. 155.05. And then we spiked with that COVID spike all the way up to, I mean, it was just a ridiculous run up, but all the way up to 200. But that was all about COVID, and it was a trade. And who would want to invest in anything with a real long-term negative yield? But now that I thought that was an interesting part, and I didn't like the way that he put it, but I like Rosenberg, and I think I really always enjoyed listening to him, and I especially when you guys are talking. But the really important part that I thought, and this is what I want to go back and listen to, was his take on history through Roosevelt and the New Deal and building the country up, having been the real end of the Depression, not World War II, but the programs, and I forget what the debt to GDP ratio was at that point that he was talking about. But now, and you made the point too and I think Rosenberg made the point in the past, is that we didn't have the workforce for the infrastructure projects. We do now. They might not have the training that's needed, and that could be remedied. But I guess the question that I have is, if the Fed is a social justice, if Fed is focused on unemployment, and they are now a social justice organization, will it be the Fed that will directly, and I know that somebody brought this up, I think it was Barry, will it be the Fed that will directly fund the infrastructure projects, or will they indirectly continue to fund it by buying all of the record amounts of treasuries that the Treasury is dumping on the market?
Well, that's Lacey Hunt's discussion.
That was Lacey Hunt, then I got that
Right.
confused. Yeah.
Which is, under the Federal Reserve Act, and Powell keeps reiterating it, the Fed is a lender, not a spender.
Yes.
So if you saw that the Fed would start using its liabilities and turning them into a spending vehicle, meaning that they were putting all those bonds out there into the system and not holding them, and actually then even for Lacey Hunt, that'd be a massive turning point. So if the Fed were to actually just totally monetize the infrastructure spending, that would be a step beyond for a lot of people.
So is the Fed, when the Fed is focusing on, how do you see the Fed directly focusing on unemployment then? Or not focusing on it, how do we see the Fed acting on their social justice platform?
Well, it's, keeping its pedal to the metal on QE and its balance sheet. So we're at maybe we're at about 6.8 trillion right now. And you have Congress and then the Treasury getting ready to ramp up another spending program. They just can't determine how large. And yes, they haven't spent all of the previous, but I would pay very close attention to the status of state county and municipal governments, because that to me is where the Fed gets very aggressive next in the muni bond market, because the revenue shortfall hitting local and regional governments is massive. Massive. You just had the New York Metropolitan Transit ask for, you know, an ungodly number. I'm not even talking about the post office. I'm just talking about the huge revenue shortfall affecting municipalities. And we haven't heard much about it, but that's what the Democrats were pushing for in Congress, of course. That's why they wanted a $3.5 trillion package, because they want a lot of that money to go to funding state and local authorities, because of course a lot of those are Democratic constituencies. And the Republicans said, no, you know, here's the way we want to do it. And as I said, Trump actually outmaneuvered him there, and they knew it, because he was appearing to protect Main Street. The Democrats were going for a big enchilada that was not really Main Street. Well, you know, we can argue, you know, what Main Street, how do we define Main Street will be the big question. But it was Trump who was trying to, the optic was that he was doing more to protect the little guy, and the Democrats were holding it up because they wanted it for untenable situations in urban environments, from New York to Chicago to LA. We'll keep going on and on and on. And we're in trouble well before this, so why are we bailing them out now? You know, and it resonates with some people. So that was a bad optic for the Democrats, very bad optic, because you know what, that plays well, and I would argue that's why Trump got elected the first time, because that was Main Street going, hey, we've had enough of you. You know what? Stop setting every, you know, you establish what is culturally, you know, no, we're not having any part of it. So it was a very dangerous road for the Democrats to go down.
Oh, that's a great point.
Very, very dangerous. And I think they, you know, so they were willing to compromise. Now it's a matter, you know, it's all politics is compromise. So you start out asking for this, you know, it's like your kid on a Saturday night. Dad, you have the car? Yeah, you can have the car. Okay, I'll be home at 12. Yeah, I'll see you at 10. Oh, come on, Dad, nobody's, you know, how about 10:30? How about 11? 10. And you meet at 10:30. He got what he really wanted. And everybody has a goal in mind.
Oh my God, that just brings up all kinds of questions and thoughts and just how do you define Main Street anymore? And that's not a question that you hear asked. No, nobody's worrying about that. You know, with the dwindling, with the dwindling middle class, and you know, exodus out of the cities from all classes, and coupled with unprecedented, maybe it's not unprecedented, just continuing the precedent set with quantitative easing and printing of money, which I think Rosenberg made that point. One of them made the point the other day. Maybe it was you that made the point that we are in MMT. You know, that we're kind of in the beginning of it. They're just printing money and buying debt with it, printing money, and they're going to then move into buying muni bonds to prop up state and local governments and keep them going. But eventually, if they don't start to create, if Congress doesn't start to create infrastructure jobs and states don't start to do that either, then where is all this money going, and what kind of a revolt, a tax revolt, or just, you know, a revolt of the silent majority that seems to be just sitting there waiting for things to happen? What will be the breaking point, both for the Fed, for the Treasury, and for that broad-based understanding of Main Street?
Well, I think it was Ritholtz who was, brought in the MMT discussion directly. I think I talked about, that the next step would be massive buying in the community market, which I think
Hmm.
it has to. Where everything I see, you know, is, listen, you go downtown, that's massive amount of sales tax revenue. That's not being made up.
Nope.
I haven't been to O'Hare, but I know enough because a good friend of mine owns Nuts on Clark. And, he's in Midway and O'Hare. So I talked to him enough. We're childhood friends. So we've been playing ball together our whole life. So we go back a long way. And he lives 3 blocks down from me. So I see him and we chat about it. So I have a sense of what's going on there. This is a huge revenue hit. I can't. And how about the parking meter deal?
Oh gosh.
Let's look at all the fallout. I was downtown last week for 3 hours, and I walked for 3.5 miles. So I got I wanted to see, because it was my first day that I'd been down there since February 5th. So I wanted to see what was going on, and and I didn't even make it over to Michigan Avenue. So there is a huge loss of revenue on the local scene. This is where the Fed's absolutely is going to have to step in and buy all those muni bonds. And then if the cities go bad, they'll just be debt forgiveness. Watch. That would be, and I'll tell you something else. Somebody asked me, well, how would you do this? If I was running the Fed right now, I would step back a little bit. But but the way that I would really get involved is that I would be putting together, because the delinquencies now in credit cards is growing from everything that I've seen. So I would be putting together asset-backed securities based on huge packages of all that credit card debt, and the Fed buying it and holding it off. That's why relieving pressures on banks, and more importantly, relieving pressure on Main Street, the consumer. That would, to me, the most direct way, say, okay, you got your credit cards are back, and I would cap interest rates, by the way. That's the way I would really, and I'd say I'm doing this for 180 days, or I'm going to do it for a whole year. And then after that, if things are returned to normal, we're going to remove the interest rate caps. We're going to do this. And that'll mean that because if I'm removing the program, that the economy is starting to pick up. Well, if they're starting to pick up, I'll certainly be able to offload a lot of that, a lot of those asset-backed securities. So, that's the way that I would be looking, because you have to come to the aid of the consumer right now. And I mean on Main Street, because you know what? You got rents in arrears. You've got a question, of how much money are they going to be getting? Are the jobs returning? Again, I just ask people, take a look at what you're, I can't tell you, there were supposed to be 3 weddings I was coming home for. They've been canceled. So when a wedding gets canceled, think about the
Oh gosh.
right? The florist, the person, maybe the people putting up tents, although the tent business, I'm sure, has been very, very good, because tents have become the mainstay of a lot of restaurants. And so I'm sure that business has not been hurt. So that's picked up. But all the people who go, waiters and waitresses, the food purveyors, and then you do the multiplier effect. So the economic impact are truly huge.
This is really interesting to me, and I know that the questions that everybody had sent were along these lines. But man, I just think that this is such a big, big topic, and this is so broad, and nobody ever seems to really be able to, as you said, kind of, put their finger on defining it anymore. And so people just throw around terms without actually reasonably defining what they are and what they mean. And so it just kind of keeps people guessing, or keeps everybody on their toes, I suppose.
Yeah, no, it's real. I mean, these are the real effects. These are people who've really gotten hurt. And then, on the political optics are terrible because one of my favorite, Chris Whalen, wrote a piece yesterday, really dissecting this. And yeah, the savings built up, which scared the Fed because people were holding on to those checks, because they were scared and there was really nothing for them to buy. But now they're running those down because, they just have to make ends meet, and the jobs haven't returned nearly as fast as, some people thought they were going to return. So, but the savings of the upper income earners have gone right into the equity markets. So they keep getting more and more on what they have, while those probably making under, I'm going to say $150,000 are busy trying to just stay current. They're not in a wealth building mode. They're not even in they're starting to run down those savings that they had built up because there was really nothing for them to do. But now, the rents are coming due, the bills are coming due. And then you want to look at something else. And there's other friends that I have, again, childhood friends of mine who I still very close with. In fact, I played golf with them on Sunday, who are who are manufacturers reps for children's clothing. You want to talk about decimation?
Oh boy.
If I'm sitting at a Zoom, I'm not buying, if my child is not going to be going to class, am I buying new clothes? Not a chance. So their inventories are just piling up because don't forget, when they planned all this, there was no COVID.
So are we just going to wait until the election before the Democrats and the Republicans are able to put a package together?
No, yeah, I think you'll get. I think neither of them want to be saddled with that. But that's, that's just a guess on my part. I think the Republicans are trying to look like they're trying to hold the line, but they've really taken the good optics of it. Well, we're protecting Main Street, which is why we're doing this, and this. And we're not just going to throw money at cities that were in trouble beforehand and let them figure that out. And don't forget, that's not a Trump bailiwick anyway. So from a political standpoint of view, you got to go, well, he's not an idiot. That makes perfect sense, because why am I going to aid these? Listen, he put together SALT, the state and local tax deal, in an effort to harm those in a direct way, basically at this constituency. So why is he going to come and help them now? Because when he brought SALT with a $10,000 cap, you could look at his face and go, okay, take that, mofos. You'll never vote for me anyway. You don't care about me anyway. Okay. So, okay, here, you're so concerned about this? Fine, live with this. So why do you think he would in any way, shape, or form come to bail them out, no matter, and if the Democrats are seen holding it up to try to aid and abet that constituency, I think that just plays to Trump anyway. And he's not going to get those votes. If you live in Chicago, if you vote for Trump, it's not going to make a difference anyway, right?
No, right.
If you live in New York, voting for Trump, not going to make a difference. You live in California, not going to make a difference. Those have been already been decided for the most part. So who are you playing to?
Can I switch gears a little bit?
Good.
and get back, I wanted to ask you about, it just popped into my mind too before before we get too far away, is with everything going on with Jackson Hole this week
Yeah.
and the Fed, and then with the big move that we had in the long bond overnight, and kind of doesn't have much of a bounce, but and the European bonds, what do we see happening with the ECB and the BOE, especially with Brexit still being kind of limbo, now starting to be addressed again openly?
You know what, Maddie, that's a good question, because again, one of the several articles I've read in the last 48 hours, somebody wrote a piece, I forgot where it was, one of these ridiculous sites, that the ECB was concerned about the strength of the euro. I don't think that's the case. That's like the inverse side, that, oh, the dollar is falling. No, it's yeah. I mean, would you prefer a weaker currency? I'm not sure, because I think that one of Lagarde's things, and she's smart enough to understand this, and she has to placate the Germans first and foremost.
Mm-hmm.
So, and with that, what they call the frugal four. So if the currency is rallying, she can turn to them and say, see, the programs that we have in place, they're not harming. They're not harming the things that you should be concerned about. It's not harming it whatsoever. So let's take that off the table. So I'm not buying, people put that, it's amazing the crap that makes its way out there. It is amazing. And I'm angry at myself that I even bother to read it, but I have to be aware of what the conversation is out there. And then I just kind of laugh about it. Again, why? And the 200-month moving average, and I say to people, and I think I talk about it in that podcast, the 200-month moving average is still 126.
Mm-hmm.
So on a mean reversion basis, on a long-term mean, we're nowhere. What? We're 1830 as I speak. So what's the difference? You haven't done anything. So, but I'm not sure that the ECB even cares at this juncture. I really don't. They got, I think the euro was under pressure because of, Brexit and people afraid. Now they seem to be less afraid of Brexit, as you can certainly see it in the British pound.
Mm-hmm.
I'm not, I don't buy, and I don't think the ECB is going to move. Again, if I ran the ECB, I'd get back to zero as fast as I could, by the way. Because all it's going to do is help the banks and really not do much of anything else.
What's keeping them from raising back to zero?
You know what? Draghi pushed this down the road. So if she were to make that move, then you'd probably get a very quick, I would say 5 to 8% rally in the euro, which is something that they want. So they won't move. Now everybody's going to take their key from the Fed. And if the Fed, the question nobody asks at these press conferences, but it'd be my first question. Chairman Powell, here's my question. I know you won't talk about the currency, but let me put it in this context. You are trying to push inflation higher. You say the Fed has an employment and inflation mandate, and you failed to reach your inflation mandate for over a decade already. Wouldn't a weaker dollar help to reach that inflation mandate? Wouldn't that serve the Fed purposes? And see how he would answer. He probably won't answer it, but that's the question I would ask. And if that's the case, then we know the Fed's not moving. And look, we just saw New Zealand last week. Everybody's just playing follow the leader. Before, the leader was the ECB, because Draghi was far more aggressive while the Fed was trying to, again, return to some sense of quote unquote normalcy. Well, of course, January 9th, 2019, that went away quickly. So now it's just a game what they used to call, somebody taught me, when I went to high school, we didn't have a track team, but I've always been a pretty good long distance runner. So when I trained with people who were really from strong running programs, we used to play a game called Indian, where you would always leap in front of the next person, and the object was to keep passing each other, which was really a great long distance running technique. So that's kind of where we're at now. Now we leap in front of each other to get more dovish. But, and this is one of the things that I liked. And that's why when Wolfgang Schweibel pivoted as far as ending his obstruction of, first of all, Eurobond, and with it, as he said, he was opposed to more loans and he was in favor of grants because he called loans like giving them stones where grants was giving them bread. That was a very significant, very, very significant pivot. So this pivot has taken place and it's bode well for the euro. The Fed will sit here. If my view about what the Fed wants on the weaker dollar, they're locked in here, but nobody else is moving anyway, right?
Mm-mm.
No, nobody else is moving. The Swedes, interestingly, and people are looking at that way that they handled the epidemic, but the Swedes moved out of negative to zero. Remember, they made that.
Oh yeah.
They'd had enough with negative. That was gutsy. I'm not looking for anybody, especially now that the Fed is its pedal to the metal, to change course here because of that. But I think it would, if I ran the euro, I'd go to zero and say, I'm sitting here until we get this, and this, and be very definitive. It's again the message that you give out. But if you look and put up the stocks of European banks, it has not bode well for European banks. Let's call it what it is.
They've been under pressure for some time though, too, haven't
Oh, God, yes. I took Kramer to task back in 2014 when he was pushing people to buy European financials. 2015. I said, you're out of your friggin' mind. And I had actually put out a recommendation in the blog too, to buy Deutsche Bank against the 200-day moving average at that time, but it was a 50-cent risk. I was very definitive. I said, here, I'm buying it, because I had traded it very well, because Deutsche actually did well for a while when the recovery was on its way. And I got out in the mid to high 30s, and I bought it back at 27.5. I was gone at 26.80. And, of course, it ran down to, I don't know, $5 or $6. And it's only trading right now $9.65, but let's see what the low was made in March, of course, at $5, $4.99. So they've been miserable. I've owned Japanese bank stocks for 10 years. I've been in them. I've made money with the initial, then I've held a rump position. It's a joke. This week they've actually moved, believe it or not, which is actually why I get a little more bullish on the end, because they were seeing it. And even with the Nikkei going up, the Japanese bank stocks have done absolutely nothing. But with the dividends, I can't possibly get hurt. Yeah, I can lose my principal, but I've made a lot more over dividends over that period of time. But I stay involved because I keep watching them. I want to see. But these have been terrible, terrible, terrible for the bank stocks. And you can see here. I'll bet the bank stocks are up today. Yeah, they are. Not great, but anytime you get two basis points steepening the curve, they're buying bank stocks. That's how desperate they are.
Oh my gosh! Do you think that the this week's move in Japanese stocks has anything to do with the Japanese knowing something more about Abe's health, or something that isn't being discussed?
I can't say that. I'm trying.
Yeah, it's just conjecture. Yeah.
Until I can ferret out a better answer. No, the yen is down for the week. So you know what? Really, how about this? Well, how much is the S&P up for the year? 7%? I don't know. What's the number now?
It's just over 8, I think. And look, I just happened to look at that yesterday for some odd reason, and I think it was just over 8. Let me look real quick.
The Nikkei is still a 0.5% lower or so on the year.
Just over 8. Yeah, isn't that crazy?
Yeah, it is absolutely. And it is interesting. See, when the yen is strong, they sell the Nikkei. But yet, when the euro is strong, they're buying DAX. Think about that. You know, I look at this all the time.
When we're trying to figure out the capital flows from I talked about this a lot. That's one of the things that Judd taught me early on. Well, it just taught me how to trade to not lose money first, and then, you know, the progression of trading. But he had me reading the Financial Times. We talked about this before. He would make me read bartended at Patrick and James and Glencoe until 2 in the morning, and then I'd have to meet him at 6 and read the Financial Times from front to cover by the time we met in the break room, the members' break room on the floor. Not so that I didn't have to answer his questions correctly, but I had to. He needed to know that I read what I needed to read in order to start to figure out. So I can look up at the board, you know, board. So I can look up at the board and be able to read the capital flows, taking money out of bonds, taking the money out of dollar, putting in, you know, and then after 10 years of ZERP, things changed, and I stopped being able to effectively read capital flows, and I stopped, you know, I was making poor decisions in longer term trades. So
Right.
I kept with the way that I manage my position, so that, you know, when the markets start trending, that last part, you know, my runner becomes a position that I'll add to as markets trend. So, and one of the great things about being in Judd's room again and being there with you when you started coming in as well with us was learning how to see the change in cap flows from one sector to another sector, from one market to another market, and then to be able to act on it. And it changes all the time, doesn't it? I mean, it's continually, you know, what's the word? It's continually being not refined, but it's fluid. You know, capital flows are fluid now.
Yes. God, yes, it's fluid. And, you know, it's funny that because I had 2 weeks ago, August 8th, after 35 years, I didn't re-up for the FT.
Yeah, that's interesting to me. What is it? Is there any particular reason?
They just irritated the shit out of me. And so many of the good people who I enjoyed reading, you know, have gone their own way. So there's only a few left who I really enjoy. But the overall news and the electronic format that they present in, after 2 weeks, this Sunday, I finally got it straightened out, because I was saying, well, they should give it to me for free anyway after all these years. And they had screwed me on something else, on a home delivery down in Arizona, which they actually stopped. And you can't even buy a print copy of the FT in Arizona. There are certain states they're not printing anymore.
Well, I don't think they're printing in Illinois soon.
It could be.
I think I got an email saying that. I've got to look back on it, but I get the print copy, but I don't read it very often except for the weekends.
Yeah. See, I used to have it both on my door, because I like having it in my hand, because when I peruse it in the hard copy, my eyes are so much trained. Okay. So, but now I was relieved finally on Sunday night that I was back with it, because I could catch up, because I really missed it. And mostly because I read critical stories out of Europe. Excuse me one second. So I was really happy to be back up with it. It was leaving a hole in some of my, even though I'm reading Bloomberg and people are, you know, I probably get 200 emails a day that have something to do with financial stories. And I can't complain. Those are my eyes and ears all over the world. So, but the FT has become such a staple of my analysis in the way that I use it. And I can't really even explain how and why, but I realized it after 2 weeks. I go, I got to get this back. Had I been blogging, my blogging would have really suffered. To tell you, I could see it. I could see it. I am back up.
Yeah, with the blog, I got that. I saw that the other day, and I'm glad for that. The blog was something that I was able to read, and I like reading too. I retain the information when I read it much more better than when I listen. A lot of people like to listen, but I'll listen to the podcast when I work out, but then I don't have notes. That's why I want to listen to the last one, so I can sit and I can take notes. I've got notes from you and Lacey Hunt, and then I didn't take notes with this last one with Rosenberg and Ritholtz.
Oh, there's a lot in there, but
oh boy, it was.
Yeah, and then there's there was a story this morning, and I've been bullish grains, so I've been buying grain stocks. That what was the story? It came out of a funky. That's what you learn. You got China dismisses food crisis rumors, says grain reserves remain high.
Yeah. Yeah, but who can trust that?
Well, that's what I read some of the thread. It's the Global Times reporting. You know what? One of the first things you learn is when people deny, it's the truth. So, I've just been watching the grain markets, and over the weekend there was talk that the crop was not as in good a shape. So, and actually on Friday I had bought back my beans. I'd been out because it was really struggling to get over 920 on the Nove. So but I trade the grains with a lot of caution, especially when you're you're coming into harvest. And it's not a weather market. Yeah, I know they talk about it as pretty dry out there. It's not a weather market. I drove, from Chicago, New York to Chicago recently. And before that, I was driving from Arizona to Chicago through Colorado, Nebraska, Iowa, Illinois. And it was, of course, just at the beginning of July. But, the crop then was pretty robust. We'll see how big it is. But now it's the question, it's going to be the global demand, and has there been enough destruction in the Chinese crop, as some people are suggesting?
Jeff just asked a question, just a real quick, simple question. What do you think of the magazine, The Economist?
Again, I used to have my lineup. That was my weekend reading. I'd read The Economist, Barron's, and the Weekend FT. And I would read, and I still read. Now I read more, but I don't read The Economist. First of all, because once the FT, there was a lot of cross-referencing. So they tried to cross-sell you, but I found that I didn't need it. And for a while, Greg irritated me. I loved The Economist when Chris Wood was the editor, who I think he's at CLSA out of Asia. Really, really good. I let that one go. Barron's to me is not worth a read. It used to be one of my mainstays, not anymore. The Roundtable got miserable. There's very little. And again, they put out a foreign exchange story over the weekend that 10 people sent me that I thought was so weak. And it solidified why I don't know. And that one used to get delivered. I don't even go out and pick it up anymore. And if there's something that's such a big story, somebody winds up sending it to me anyway, and I'll take a look at it. But I don't read Barron's. The Economist always was a great read. I just, I've had to cut a few things out because I've picked up other things. So that was one that went.
Did you happen to see the Forex Factory had a headline 30 minutes ago? American Airlines is cutting 19,000 jobs when federal aid expires in October.
I see that. Yes, I saw that. So, you know what? Will we get to that point? Because article in, I guess, the Wall Street Journal by Greg Ip on the mistakes of a lockdown.
Oh boy.
So, you know what? People are coming out. So yes, so The Economist is really, it's a very fine magazine. I just stopped reading it because some things had to go, and I prioritized what I needed to read. And I realized with the FT, it's the here. Like if I click on it, I always have it up. So, you know, I click and they run through a lot of headlines. They're not nearly as good as Bloomberg, but I don't want to spend $2,800 a month, you know, for a Bloomberg machine.
Yeah, no kidding.
And again, I get inundated from all corners because anybody who has a Bloomberg grabs a story. So, you know, all the people I know in bond trading rooms, because all they're doing is trying to bounce stuff off of me anyway and get my thought on it. So it's a good way for me to take a look at some things. So I find a lot of them is wasted, but you don't know it's wasted until you take a look at it yourself. And I learned long ago it's very difficult for me to depend on other eyes. Send me the story and let me read it, and I'll look for the nuance in there to see if there's any. You know, that was where I would lock up with Ritholtz, because he doesn't see nuance at all.
No, he's a black and white. Yeah, I picked up on that pretty quickly with him, especially with the tone that he spoke in. Everybody's Ira, you know, and I have a feeling I know how you're going to answer it, but I'm going to ask anyway. Is because I know it's on everybody's mind. How high can the equities continue to rally, especially the indices? The S&P is starting to catch some steam against the Nasdaq. The Nasdaq has been weaker. The last 4 or 5 days, last 4 or 5 sessions against the SPOOs. So the SPOOs are playing a little bit of catch up.
Yeah, which they should, because don't forget, well, you know, except that the Nasdaq giants do pay dividends, but people are searching for yield. And as I talked about with the Rosenberg on that podcast, and I think it was Ed Yardini who said it, that the world has really been turned upside down when you buy bonds for capital appreciation. I was digging back at Rosenberg with that, and equities for yield. You know, you really have to think about that.
Yeah.
And that's the world in which we live. So, you know what? Again, as I'm not in big tech at this time, to my chagrin, but that's a decision I made. But for the last 3-4 months, I've just been slowly building a position in the I think the unloved stocks that will do well if the Fed gets their inflation outcome. And so much of what I believe is built on the Fed being successful. I mean, that's why I've always said I don't buy gold for inflation. I buy it, you know, because of the Fed fears deflation. Well, if that's the case, the outcome has to be at some point an inflationary thrust. So then I'm looking at what companies are going to do well. Now, you know, somebody called me yesterday and they want me to join this group, but it entails me, you know, putting in levels, and that's not what I do. And they said, no, you have to do that. I said, no, you don't understand. I want people to do their own technical work because I'm not going to define your risk parameters.
No.
And we spent 20 minutes discussing that. That's what people want. You don't understand. He says, you're just talking to too many people who are more professional. I said, well, that's who I cater to, but I don't tout stuff. So I can give you a view as to where I think things are going based on this, and this. And you have to do your own work to set your own parameters of what your risk levels are. I'm not going to define that for you. Because risk levels are different than yours. Because I'll get into a trade 10 different times And you may sit there, and rightfully so. I mean, had I just sat long gold, it would have been a far better trade.
Yeah, you and me both.
Well, but on the other hand, when it dropped $150, what, last week, or how comfortable? I'm never comfortable. I'm a trader. So that leaves me very uncomfortable. Back in March, April, when we had a $200 break, how comfortable were you?
None. I pitched them.
Right. That's right. So,
And I hesitated in buying them back.
so that has to be in my equation. And that's not what I'm geared for. So I can help sort people through the headlines and what I believe is coming without developing, by debunking certain narratives. And I agreed. I thought that Ritholtz did a very good job. But all he was doing was picking up from Ben Hunt, and I didn't want to burst his bubble. I didn't want to be like Ty Webb from Caddyshack, you know. Because so much of that is Ben Hunt's work about narratives, and he's done great work on narratives. So these are, and getting to see how false narratives are put out there. Like now with this, oh, the dollar, the end of the dollar. There's no such thing. And a move upward in the euro does not signify the end of the dollar. You know, it's just markets, you know, doing what markets do. And as many good, you know, what's it, Morgan Housel and others who really study the psychology of markets, a market's job is to cause the most pain and aggravation as possible and discomfort. That's where markets are. If it was that easy, everybody would be friggin' doing it. No, markets are supposed to cause. Capitalism is supposed to make you uncomfortable. So,
Oh, I got to write that down. Capitalism is supposed to make you uncomfortable.
Hey, listen, in a good capitalist system, you have competitors coming at you all the time. How comfortable? You never rest on your laurels.
No.
You never rest, because in the way capitalism works, somebody's always coming to you know, how does what's his name say? You know, they want to steal the jester's crown. They want to steal the king's crown always.
Mm-hmm.
Always.
Does anybody have it? Lars or Michael, Robert, any Europeans have any questions that you guys want to ask? Anybody else? Andrew, if you're here, or anybody else in the US, anything? Feel free to unmute and just go ahead and ask, or any clarification that you want from anything that we talked about today. This is, again, I've got 2.5 pages of notes.
Uh-oh.
Always gives me something to when I do my homework later, I'll sit down and start looking through different thoughts.
Hold on a second.
Sure.
Let me mute you. Hold on.
So you guys feel free to before we wind up or while we're winding up, just go ahead and ask. It was very informative, wasn't it, Robert? Always is. Weston, Woj, I'm not real sure where you guys are, but feel free to ask questions. This is our time. This is our time to ask the best fundamental analyst and fundamental trader, macro trader that I know. So the S&P got up to 34 even while we were talking, so not enough to get back into Rhonda, back into the room you know, not enough to get back into the opening range. So still short, you know, or you could have reloaded, and I know that some of you did. So you reload up there and pay for the trade again, manage it the same way. You can take profit down here to 24 because it's shown itself to be a pretty good level. I wouldn't be surprised if we run back up through the opening range on the upside later, or if we head back down to 34.10. Maybe even try to close that gap from Sunday night. During the day, I want to see us close it during the day. The pit gap. Gold, oil came off a bit. And bonds found their, looks like the 30-year found their low. At least for now. Oh, look at that, right at the target. 177.19 is the low. And our target was 177.19. I'm not going to retweet Ira's blog post this week because I already retweeted the, I've already tweeted and retweeted the,
All right, I'm back.
okay, I was wondering if you're,
You know what? Grandsons take priority.
oh, always. Oh,
First day of school.
oh, no kidding. Is he excited or was he nervous?
He's 19 months old. This is like, no, my daughter was upset that he didn't even look back at her. And we laughed because she's my oldest, and it's exactly how she was when she went to school. Like, get the hell out of here. She was so ready to get that, in preschool. She was so ready to get, and she's still that way. So I said, yeah, payback. She says, no, I'm happy. I said, yeah, you should be, because you want him to be comfortable enough to separate from you.
Yeah, no kidding.
Okay, what do we got? I'm sorry.
All right, so there was one more question that says there's been news of a couple companies rotating cash holdings in Bitcoin. Granted, these are small private tech companies. What do you look for to see a greater adoption of Bitcoin? Actually, that's a good question. What would you look for to see a greater adoption of Bitcoin? We kind of touched on this a little bit last week. So what do you look for to see a greater? What would you look for to see a greater adoption of Bitcoin in the corporate world?
Okay, I'm going to go back to what I said with Anthony back in October of 2016 when we did that thing live, when we did live cast with
Santelli.
And when the Bitcoin was asked about that, and I've been dead wrong about Bitcoin as far as valuation. And I said then, and I'll say it now, I really don't care about Bitcoin. I mean, I can trade it, and it's interesting. I'm much more interested in blockchain, and I'm actually involved with the group very minorly. I just provide them with foreign exchange expertise on blockchain. So the blockchain element is much more interesting to me. The reason that I was never a big fan of Bitcoin because I thought that all the individual central banks would create their own cryptocurrencies, because my stance has been that governments don't like competition. That's why they have monopolies on the printing of currencies. They don't want competition. So So in the government world, I expect to see at some point a proliferation of cryptocurrencies. Now, in the corporate, listen, from a ledger standpoint, it I see it, and especially now that the central banks have done so much to debase their currencies. That's a strong word. I really shouldn't say debase, but they keep downward pressure on their currencies as they seek to find ways to stimulate growth. Bitcoin has gotten more attraction because, again, it's for some people, it's become a useful store of value as long as it's that, and for people probably in emerging markets who are really, struggling to find ways to secure the underlying value of their money, it's found purpose. And outside, I really can't speak to it beyond that. I just don't know. It's not my comfort zone because I've always said I can do that with gold, and I have much more sense of gold and how gold operates and what its purpose is. So I'm just more comfortable with it. And I'm not a fan of electronic money now, because electronic money to me is just a methodology now being put forth by academics, and it's spreading in order for them to be able to manipulate you and your money better. Now, that's not a conspiratorial view. I've read a lot of the academic studies on this, and by going to electronic money, it's much easier. You can't separate what I'm going to tell you here. It's much easier to go to negative interest rates. The only reason that Europe didn't go even more negative is because negative interest rates, because people can take their money out of the banks, they don't want to pay it. They can put it into gold, they can put it into other things, and there is a break point. What is that break point? Is it negative 25? Is it negative 50? Well, even in Europe, they've played with a tiering mechanism so as not to punish depositors yet. But if they really wanted to get that money flowing, if it was all electronic, then you go to negative 5%. You go to negative 5%. And all of a sudden, and that's what a lot of these theoretical studies talk about. They don't know what that level is either. But at some point, if you're being punished for holding your money, you're going to spend it like mad, which is the basis of what that's about. So I don't like electronic money at this point, at this juncture, because to me, the ability to do what I want to do with my money at any one time is one of the liberties that I place very high value on. And there was electronic money, and they could just keep, massaging interest rates lower and lower and lower in order to get me to spend, even though I have no desire to spend, but just because it becomes the de facto only real alternative, I'm in opposition to that. And this is not a conspiracy. I'm not giving you can go read the studies. They're out there about electronic money. I'll tell you who's writing. Larry Summers wrote some pieces. He did it because we could control drug money. Rogoff is written copious amount. That's why they took some of the big bills out. It's under the guise of drug money. But really what they wanted to do is to prevent people from stashing money. Because when people stash money during times of very low interest or negative interest rates, then the money doesn't circulate. And the modern banking is built on the circulation of money. It's how the economy really gets its mojo going. But when people are uncertain, that money ain't flowing. Is what Keynes was very well aware of and discussing the paradox of thrift. And this is something that they want to overcome. Now, COVID has given them new cover, right? Because we heard it at the beginning. The virus is transmitted with cash. Don't use cash. And I go to places now. It irritates the shit out of me that I can't spend cash.
Me too.
Credit cards.
Can I push back a little bit on that, or at least take the conversation of maybe a little bit of a different vein?
Sure.
Sure.
So I'm looking at Bitcoin, not so much for the utility of it, because I would agree with you that other tokens have a greater utility factor to them, and they solve problems in a more, I would say, direct way. I think where Bitcoin is interesting is that it seems to be the lead indicator of where the crypto market is going. Like, not from the ERC20 standpoint, but just crypto as a whole in terms of how a normal person on the street is going to think about it. And so when I try and look at crypto as an asset class and see where it's going, I think Bitcoin is an indicator for that. So that's where I think I agree with a lot of your points. In many ways, I want to be on the right side of where crypto goes, whether it's to zero or to infinity. And I think for me, Bitcoin is kind of that leading indicator that I look for.
There's not a thing you said that I disagree with. I agree with every one of those statements. Now, that doesn't mean that it's suitable for me, but I believe that that's what Bitcoin has done. And everything you said, I had a conversation before. Some people had called me in when the CME was going to list Bitcoin, because there was a lot of discussion about it. I guess I wasn't privy to that discussion, but they wanted to test my metals as my expertise in the FX market, what I thought about it. And my comment really, when I thought about, and I thought about it long and hard before that, which is why they wanted to why they bothered to ask my opinion, that if you're in the risk management business, you have to be involved in it, right? Bitcoin is, and I agree, cutting edge, and it is the token of choice, and you must be aware of it and see it through. You can't avoid it and say, well, it's not for me. If I'm in the risk management business, I'm in the risk management business. And if it becomes an acceptable medium, I have to be in that medium. So there's not a thing you said that I disagree with. But I don't just view Bitcoin as electronic money. I happen to agree with you. It's bigger than that. And one of my fears about it was that it was going to take off. And again, that the government was going, meaning US government or any other government, and we've seen other governments step in, by the way, and voice their opposition in some way. But I said, if we see a terrorist attack that the authorities say was funded by Bitcoin, the government will shut it down. That was what scared me more than anything. Because I'm a libertarian by nature. Not to say that I don't believe that there's not a role for government. I believe there's a role for government. I'm not opposed to regulation. I'm always in favor of quality regulation. The worst thing that happens is that those who get regulated lobby so much that they water down the regulation. The regulation becomes less than worthless. You would have been better without any. And I'm totally opposed to that. I'm always in favor of quality regulation. If you're going to have a regulator, have a knowledgeable regulator and somebody who really understands what they're regulating, because you'll get better regulation rather than always lobbying it to death, and you fall on your own sword because you wind up with a crappy regulator. Does that? But I don't disagree with the word you said.
Yeah, I think that makes a lot of sense there. Bitcoin can be the poster child or the person that you frame for the problem.
Right. Yeah.
So it has a lot of weird characteristics. I think the crypto space is here to stay. I think it's just in many ways trying to figure out who's in the top of the pack and who's in the bottom.
That's so well put. That's exactly right. And it's here to stay. It's not going. You know, there are many new things in this world that I would never have thought about 10 years ago. They're here. They're here. You know what? It's what makes the world so interesting. Now I have to learn how to maneuver in that world. Because really, at the end of the day, I always go back to Mark Twain's comment, or even King Solomon. There's nothing new under the sun. It takes on a different medium, but the underlying concept, we've seen it before. It's just a matter of understanding it. You know, the world is filled with currencies that have come and gone. God, thousands over the history. You know, seashells. You know, we've always. You know, it's why one of the few laws of economics that I think really has teeth is Gresham's law. Which is bad money drives out good, meaning that people will hoard good money, which gets back to the area of negative interest rates, and spend the crappy money. You know, when it comes to people's money, it's amazing how the average common man, so to speak, is very aware how things work. My wife has for years done tax returns through Robin Hood Foundation and through the IRS groups for people who make less than X amount of money a year and who need help filing their taxes, and there's no charge to them. And if you asked most people sitting on this conversation how the earned income tax credit works, you'd be hard pressed to get a real reliable answer. And yet my wife would find people who really don't have much education can know far more about the earned income tax credit than 95% of the population. They know. It always amazed her how they could read you chapter and verse and they knew everything coming in. So Dan hears what he wants to hear and disregards the rest, but learns. And when it comes to people's money, that's why Gresham's law works, because again, bad money gets spent and good money gets hoarded.
Just went from King Solomon, Mark Twain, straight to Simon and Garfunkel.
Yeah,
well done.
Right.
Well
that's
done.
Right. That's right.
See if we can get a Casino, Goodfellas, or Bronx Tale. Bronx Tale's got the best. Get Bronx Tale.
You know, but that's because the Fed exists in a world where there is, and it's my problem with all the central banks.
No, you can't leave.
They don't have. We saw what happened when twice they were going to really exit. Well, three times. Yellen, I think, really had the best intentions, but when Bernanke ran into the taper tantrum in 2013, put his tail between his legs and ran. And we saw with Powell, because Powell tried to do it too aggressively by the double shotgun approach, quantitative tightening as well as raising rates at the same time. And then he ran for the woods for cover in January 2019 because it was, as Stanley Druckenmiller said, the double shotgun approach. But I will say that Rick Santelli and I discussed this back in July of 2018. When I was on with him, we were talking about how they were going to proceed before he did it. And I said, choose one or the other, which he would have been much better at. Doing both created way much concern for the markets and the drawdown in liquidity too fast. So he made it, and then he had to pivot and reverse, you know, by putting the pedal to the metal, and then he ran into COVID. So I don't know how they, and I think that's what really concerns the gold market and maybe the dollar at this juncture. How do they extricate themselves from this?
We had a nice rally going back. Isn't that when gold, I got to look, but isn't that when gold started to take off? Was in January of 19 or going into the
Actually
beginning of the
broke
year?
out of that 1250 to 1350 range at the Fed meeting when he really throws it.
Yeah, it was beforehand.
That was June 17th, 18th
Yeah, that was before. Yeah.
of 2019. It was 2019. I know exactly where I was. There was a Fed meeting, and then gold breaks out of it. Gold gapped that 1370 area.
Oh, that's when I flattened up. I started buying it at 1240, 1260. I
Yeah,
flattened
we
up
were
at,
talking, right?
yeah. And I flattened up at 1352 on my way down. That's right. That was January. I flattened up at 1352 in front of the FOMC meeting on the way down to Myrtle Beach, so I didn't have to worry about it. And I ended up reestablishing a position at 1516.
Yeah, but the next day,
That's right.
got into the 1400s very quickly because I was down in Dallas. My brother-in-law had passed away, and that was the day of the funeral. So I know I wasn't attentive, but I was attentive later in the day when I was able to sit down and when I saw, when I watched the replay of I said, wow, this is really a dovish speech. And when I saw the price action, it made perfect sense because that was absolutely the final capitulation.
Man, I gave up good $80 in that.
Yeah,
in that trade.
okay, but you know what? Sometimes to sleep, for chance to dream is, now we're into Shakespeare, so we'll cover it all.
I was trying to figure that one out real fast. Shakespeare is not one of my strong suits.
Oh, come on. You went to De La Salle. The nuns beat you with a hammer in order.
They did. Maybe that's why I never got into them too much because they just.
All right. But you know what? That's the way that I see this setting up. All of a sudden the market wants, that's why I really take umbrage with the CNBC headline. I thought that was, come on, don't sensationalize it. You got something to say it. Because when I read the story, I said, I don't see it. And when I know more, these guys from Praxis, who I work with, they're posting some stuff too. They're concerned about what's going on with Abe. Does it mean that there has to be a new election? And I can't get a friggin' answer. Yeah.
You will.
Yeah, I know. The book is out. It can be ordered. It won't be out in the States until October, but it's gotten really good reviews. Doesn't surprise me. My son is a diligent academic type person. Always has been his whole life. But pushed him to wrestle and play some baseball. So I played a lot of baseball. So he'd be a human being, and he is. He's a really good human being.
When's our favorite Bloomberg writer going back?
Oh yeah, she's motherhood. I'm not sure. She gets to December. Bloomberg is a very progressive organization.
That's great.
And they do 6-month maternity leave, but I think that's a lot.
No, I do too, but it's great for the moms. It's great for
It is great for the moms. And the problem is with COVID that her husband, my son-in-law, who I really adore, is working from home too, and they live in an 800 square foot apartment or so.
Oh boy.
So with a baby, it's not easy, and it's been really hot out. So she hasn't really, wanted to. In the 90s, she took out one day and she felt that she got a little dehydrated, so she went right back to okay. So you're really on top of each other. It's not an easy existence.
No, I couldn't imagine. I just couldn't imagine.
It's not an easy existence. Anything else before I?
Anything else, anybody? It was a great conversation, Ira. I mean, always. And thank you so much. And I hate feeling like we're taking too much of your time, but I just keep always telling everybody to, anytime we have questions, just to shoot them to me and I'll get them into you.
Yeah, no, don't listen. Again, this is how I learned too, because the questions are, are really good. And people ask what you want to ask. You know, I love the Bitcoin question and push back at me. You know, to me, I'm here to learn from everybody too. And there's many things that I don't know about. As long as I've done this and the things I look at, but you know, the fresh eyes are fresh eyes, and this is a group of professionals, and that does take it up. As I had this conversation with this group yesterday, who's going for the mass numbers, and do I want to be a part of it? I have to think about it, because he says, well, don't you want to monetize? Yes, I've always wanted to monetize. And it's one of the things, I'm building out a platform for myself now where everything I do and have done will be aggregated.
Good.
You can go and dig into the archives. We're working.
Good.
Oh,
Judd, good.
I want Lizzie to talk to
Jack.
Jack.
Yeah. All right. We'll set that up.
Okay. Yeah. Because Jack could be a help to her. And, you know, and she was, you know, now that her oldest, the 19-month-old is headed to school 2 or 3 days a week, she'll have more time for me. So
All right. Beautiful. All right,
working
we'll
on
get
it.
that together.
Working on it. And I'm trying to dig out some more things on Abe, but let me see what I can find. I'm sure he's busy because he must be getting, I mean, he's the go-to for a lot of media. So let's see what he comes up with.
All right. Shoot me a message, will you? Let
I
me
will.
know what he comes up with.
I will.
All right.
All right.
Thanks. Thank
Bye,
you so much,
everybody.
Ira.
Yeah.
Thanks so
Okay.
much.
All right. Pleasure.
All right. Bye-bye.